watching out there.
All right. I'll work on times with you
Start stream.
at another time.
Stream health is starting.
All right. So
I see. I keep forgetting you're not watching me on the camera that I'm looking at, because I'm looking and I can see you just fine, even though you're over on that monitor. So, all right.
We are live.
Oh yeah, I should bring up our notes and all that good stuff
On the YouTube. Huh?
We got a question in our email. Should we just go ahead and answer that tonight?
I think we should answer it during the episode. What do you think?
Yeah.
Yeah, we can just talk about it. I think that's a good idea. We'll start doing that maybe in the beginning of every show. We can start
just saw this from Jay. We also have a new review on iTunes.
Oh, wonderful. Thank you, people. Thank you, everybody. You want to keep us going, I guess.
Yeah. And we got someone, well, is this your dad asked to change the email address?
Yeah. I already did that.
You already did that? Okay.
Yeah.
I want to delete the email.
That's funny.
All right. I'm reading Jay's question.
Yeah, we can bring that up. That'll be a good one.
Yeah.
I mean, we'll just...
Oh, hold on. I got to do some retweeting.
Oh, yeah. Me too. We are live. Come join the fun.
We confirmed our...
On the YouTube.
We confirmed our keynote speaker for Revolution Conf.
I saw that. I got the email. That's awesome.
So that's a pretty big deal. The Secretary of Technology for the state of Virginia, and it's a woman, so that helps.
That's great. That's so cool.
So
I'm very excited to come now. I can't wait.
Yeah, it's gonna be a good time. All right. You know what? Oh, I should bring up. Sorry. I keep forgetting there's a checklist of stuff I should do. Let's bring up Audacity. All right, let's bring the mic in a little so people can hear me. What episode's going live tonight? It's Unshakable, right?
That's right.
The third one we did.
Chapter 7.
No, that's going live. So out on public.
I believe it is the third one.
All right.
So you can go to raw.2frugaldudes.com to see all the raw videos.
The raw. All right. Yeah, I don't edit these at all. They just go up, and that's what you get.
Yeah, this would this would be our third one. That's right.
See, I wish I could add, like, let me try this. Hold on. Yeah, that's what I want to do. Move that over here. Are you watching live feed?
No.
Yeah, so you should watch the live feed, because now I'm doing new stuff.
What logo is on there?
I'm putting our Twitters.
Oh, cool.
Except I want to background opacity. Outline. Hey, there we go. There we go. Wait, no. Put that back. All right. Sorry, I'm effing around on on this. So
no worries.
Hey, that almost kind of works. Almost. All right. So chat log mode. What's chat log mode? I don't know what any of this stuff is. I need to sit down and actually learn how to use the software, because I think my life would go easier if I learned how to use the software.
OBS?
If I just learned how to use the software. There's no copy.
All right.
Hold on.
Let's see. No responses for any bad things, so that's good.
All right. So
all right.
I want to add text again. All right. Who are you? You're just Marin Sean. Marin Sean. What color do you want to be? Do you want to be? I'm green. What color do you want to be?
Orange, my son's favorite color.
All right.
I don't know my daughter's yet.
Let me find an orange.
She hasn't figured that out.
All right. So, and then I'm gonna add an outline. You know what? That works. That works well enough. Well enough. There we go. Kevin and Sean. All right. Yeah, you watch on the live feed. I'm like adding the name. It's like I almost need a different scene to go back and forth.
That's awesome.
So I could do this fade in, fade out effect. So let me say. So I could do this. I don't know if you're watching the feed. I could do this. Add one that's so essentially. Why is it? My video is frozen now on the thing. Crap! I broke it, Sean. All right. Oh man, I broke it. Audio, video, Kevin.
Totally think Skype is messing with my audio right now. I'm using the Windows 10 Skype. It doesn't have the settings or the level settings, but something's messed up.
No, don't use that one. Use that one. All right, I fixed it. Cool. Yeah, so the one person watching the feed's like, what are they doing?
Seeing stuff fly all over the screen.
Why don't they just start the show? This is how
it's raw.
It's raw. And raw.
The behind the scenes. We'll get started here in a moment.
All right. All right, let me bring up our Two Frugal Dudes script. Have you already edited it?
Yes.
Yeah, because you're good about that stuff. I just show up.
That works. Hey, you're doing the live feed.
Yeah. I add what I can when I can. So I'm just going to add, hello, everybody. All right. I am ready to record on your mark.
Alrighty. Let me pull it up. 1, 2, 3, record.
And we're live.
Well,
liver.
Liver than we were.
Yeah.
All right. Cool. Ready to rock?
Let's go. Let's do it.
All right. Welcome to Two Frugal Dudes, episode 26 on our Unshakable book study, part 6. My name is Sean Marin, and I work as a 9-to-5 full-time employee for a large corporation. Join me on my mission to help more people achieve financial freedom faster through my work at earlyretirementroadmap.com.
And my name is Kevin Griffin, and I own my own software consulting business. If you're looking to give your development team or project a swift kick in the pants, let me know how I can help at swiftkick.in. We are not financial experts. We are just two middle-class guys that want to make money, keep money, and live fruitful lives. Please don't take any of our advice without first doing your own research or consulting with a fiduciary advisor. Now, let's get our money working. Hi, Sean.
Hey, Kevin.
How's it going, sir?
Things are going pretty good.
Yeah, it's
good over here.
Another late night. We're live on the YouTubes.
Yeah, I did set up those domains, by the way. So if by the time this recording goes out, anyone that ever wants to join us and see the raw YouTube live stream going on, they can go to live.twofrugaldudes.com to be directed straight over to it. And I also set up raw.twofrugaldudes.com if you want to see any previous live recordings to see how it goes down.
Yes, sir. And we also have our first set of announcements to make. We're going to start a giveaway.
That's right.
So every month we want to give away a book to our awesome listeners. This month we're giving away Unshakable by Tony Robbins. So if you've been listening to this series of podcasts and you're really interested in what the book's about, but you're too frugal to actually go buy the book, you should ask us a question, and we will give away a copy. So, like I said, all you have to do is ask us a question, either on Twitter, our website, on this YouTube stream, or you could email it to us at dudes@twofrugaldudes.com. We'll not only answer the question live, but we'll enter you in the drawing. So right now we're at the beginning of May. So I would assume in June, beginning of June, we'll pick our first winner, and we'll announce them on the air, and you'll get an email. Which we announce this on the Twitters, and we have our first question. So Sean, do you have it up? Do you want to read it?
Yeah, sure thing. So, let's see here. Pulling it up on the phone right now. All right. So, our first question from Jay Woodcock is, "What's the best?" From Jay Woodcock. Sorry, Jay.
All right, start that over again. Yeah.
Can't cut that on the live stream.
That's fine, but yeah, no one's watching anyway.
So, what's the best or most cost-effective cloud-based backup for my multi-machine family, desktop, laptops, phones, etc.? He's been doing some research a ton because the desktop alone has, 4 1 terabyte drives running out of space trying to back up photos, edited videos, etc. I think weighted all the factors to go with the well-rounded crash plan. But what do the two frugal dudes think?
I use Crash Plan.
So
that's what I use, and I have a couple terabytes of stuff up there. I rip all my movies, so I have a 4 terabyte hard drive that I store them all on, and then those are cloud backed up, along with pictures and stuff like that. But really, I've moved a lot of my just regular daily use stuff to cloud services, like all my emails up in a cloud service. I put a ton of stuff in OneDrive or Dropbox, and I also any of my work I do software wise is up in GitHub. It's always committed. So the worst case scenario is the laptop I'm on dies. I change out a hard drive, get a new laptop. I really am not out that much. It should take me all of a couple hours in an afternoon to put a laptop back together. But that doesn't do you much good for things like photos and videos and all that big media heavy stuff. For that, I use Crash Plan. I've just been happy with Crash Plan. So they're not a sponsor or anything. They could be if they wanted to. But I've just been using them for years. Before Crash Plan, I used Backblaze.
Okay.
And Backblaze was good. The problem with Backblaze was it started getting too expensive for me. But this has been years, and plans change, the programs change. There's other.
So what's the big difference between like that and like a Google or a OneDrive? A Google Drive or OneDrive. I mean, is it cheaper actually, or is it just the service? It's
more cost effective for large amounts of data, like for Google Drive, for OneDrive, sort of thing. You're very limited by space. With Crash Plan, I can back up all my machines for a yearly rate, unlimited. So Jay talking about 4 1 terabyte drives, that's you just upload them all to Crash Plan, and it's there. The biggest problem with these backup services isn't so much the backing up; it's more the restore. Because if, let's say I delete something, it'll retain any file changes for a year, 2 years. I forgot what I get out of the box. So if I change something today and it gets backed up, and then 3 weeks from now I change it again, I'm like, oh crap, I need to go back to what I originally had. That's a quick jump for me to do. I just have to go in and tell it, I need this copy from this time. It's retaining all that. Now imagine I have 3 terabytes worth of stuff And if it's retaining
incremental
changes, which there aren't that many. That's kind of a nice thing to not have to pay per terabyte for or per gigabyte for.
True.
There are other services out there that kind of let you roll your own. So if you want to use Glacier on Amazon Web Services, which is cold storage, which means you don't pay anything to put it into backup. You pay a minimal fee per gigabyte to store it. You get nailed on retrieval though. So whenever you try to take that data back out, it costs you money. So, but it's a little cheaper to store it long term. Azure has similar services or cold storage service, so you could put it up and store it cheaply. And that's actually one of the things I do with what I do with videos is I'll take all the Blu-rays we own and I'll rip them, and I'll have the raw rips, and I put the raw rips up into Azure Cold Storage, so I don't have to physically keep them on the hard drive, and I just keep my converted 1080p copies on the hard drive. But that's the difference of a converted 5-6 gigabyte file versus a 30 gigabyte file,
right.
Or a set of files. But I don't want to lose those rips. I want to have access to those rips. I just don't want to store them on my own devices. So I put those up in Azure Cloud Storage, and they cost me cents per gigabyte, basically.
Yeah.
So that's what I do.
Well, wow, yeah. Well, what I do is going to be nothing compared to that. I'm much more simpler than that. So I used to have before, back in the day, I used to have a lot of music, like tons.
Yeah.
Like you said, like a terabyte, probably just music alone. And then I used to do the same thing. I used to have a bunch of movies and videos and stuff. And then when I started moving to cloud, and same kind of deal, when I started moving between devices, I looked into that and I was like, you know what? I just need to get rid of this stuff. Yeah. I just had to. I was like, I'm never watching any of these movies. I'm never listening to any of this music. I just have too much. And I really went and started cutting back personally. And I got down. Now I'm only at like 200 gigs of everything I need.
Lightweight.
Yeah. So I'm traveling light. So I have a folder called files at the root of my cloud drive. I use OneDrive. And literally everything all my pictures, videos, documents, code I write, everything is under that folder. And it's all backed up on the cloud. So, and I haven't noticed any performance issues either. It just kind of syncs it every once in a while. But so literally my whole basically doc store of everything I need, all my files are on the cloud. So I won't lose anything if my laptop were to crash or something. I could just reformat it, and I would have to just install a few applications, but all the settings files and everything, I have access to those. So that's great.
Funny you mentioned music, because one of the things I didn't even consider is I used to have a massive music collection as well. Yeah. And I had this bad habit in college. I would go to the library and rent CDs, and I would come back and rip the CDs, and it would just magically become part of my music collection. But when I got Spotify, I basically had no use for my music collection anymore. And I think I still have it ripped somewhere. I just need to go hit delete on that sucker, because 95% of the music I would listen to in that collection is on Spotify. And I pay $9 a month for Spotify, and it's available everywhere I want to be. And I think there's only a couple artists that aren't available on Spotify, but oh well.
Yeah, that's exactly the same route I learned, but I actually went the Amazon Prime music route.
Yeah, so I have that too.
I get all my music on Amazon Prime. I already have Amazon Prime, so I'm getting the music I want as well. I get all kinds of stations on there, playlists. Most of the artists I care about are on there. So yeah, I put all my music and old videos and stuff that I couldn't I couldn't get to the cloud, or I didn't want to worry about it. I put them all on a drive and put them somewhere. But like all my videos and pictures now are all taken on my phone, and they're automatically backed up to Google. I use the Google picture backup, so that's unlimited photos and videos. I think it's unlimited anyways. And
you'll find out.
So I'll find out. So I haven't had an issue there or anything. So I mean, I mean, really, I just travel light. I haven't needed it. I tried doing the same thing with Google Drive in the past, but I had performance issues actually on my PC trying to back everything up and use that drive at the same time with Google Drive. So I switched to OneDrive, and it's been pretty nice. So they're doing something right there, I guess.
Nice.
But
Well, let's
yeah,
move on. So thank you, Jay.
hopefully that helps you out, man.
So you are now entered into our drawing for the Unshakable book. And great question.
Yeah. And wow, we're gonna have a lot to talk about tonight because we're talking about chapter 7 of the Unshakable book, and
Slay the Bear.
Slay the Bear.
It's not so much like talking points as it is stories. It's very story filled, and when there's a section of the chapter where it's not even Tony, it's another gentleman, basically giving really good advice.
Right.
Like
Peter Malik. I don't know if I'm saying that right. From Creative Planning, I believe.
Malik, yeah, I'm not quite sure. That sounds right.
Okay.
But it was a lot of just really good advice. And
it was really good. Yeah.
The chapter kind of starts out with a story about Tony, and Tony's if no one's seen Tony Robbins, you should probably like just go look him up. He has a great documentary on Netflix about being Tony Robbins. Tony Robbins is a big dude, and I'm not talking like fat. He is built. Where like, I'm a big guy as well. If I stood next to Tony Robbins, I would be small. He's just a tall dude. But he was talking about a chat with his doctor, where his doctor was concerned that he had a tumor on his thyroid, and it was causing him to produce excessive human growth hormone. So he was growing bigger, and he had kind of leveled off, but the doctor was concerned about this tumor. And the doctor told Tony, you need to fly back to the United States right now, and we have to operate and remove that tumor. Now, this is on his like thyroid gland, which is, in your head. And that's not a just in and out surgery. That's kind of a big deal. And Tony said, you know what? I'm just going to ignore it for now. And it's not causing me any issues. I feel fine. He finishes what he's doing. He goes back to the States. He talks to his doctor. Doctor says, I got to operate now. And Tony does. He said, I'm going to go get a second opinion. So Tony goes and gets a second opinion. And doctor says, no, you don't need to operate on it, but I want to pump you full of drugs. And Tony says, well, what would the drugs do? Well, the drugs would maybe shrink the tumor a little, keep it from growing. All right, what are the side effects from the drugs? Well, you might lose some of your energy, or you might a couple bad side effects from the drugs. Yep. And Tony said, he ended up saying no, and he didn't take the recommended solution for each of these doctors. And it turns out the drug that he would have taken was banned by the FDA here in the States because I don't remember why they banned it.
Causes cancer.
Oh yeah, that's right. It caused cancer. Oh well. So the tumor that Tony had wasn't cancerous or anything. It was just a growth in his head that caused him to become massively big. But
and it's like 25 years later, and he's still living with it. And he just says, I just do a few tests every year to make sure everything's going all right, and just living with it.
And he's doing fine. And you watch the documentary, he's in peak physical health for however old he is. But it's like, I would want to be like Tony Robbins. So if I was built like Tony Robbins, I'd be just fine.
I like the analogy you use, like the butcher's going to want to butcher and the baker's going to want to bake, right? So the guy who's used to going to the knife is going to want to cut it out. The guy who's used to trying some new drugs is going to want to try some new stuff. I mean, you do what you know, right?
It's like we're engineers, and I see every problem as an engineering problem. And I need to stop doing that in a lot of cases because not every problem... we create solutions for different problems that really exist.
Yeah. So I mean, it's like this. It's like the theme of the book here. He's kind of reiterating once again. We kind of see this in every chapter of being able to tackle fear, right? And again, when everything's going on, weathering the storms, being unshakable, being certain in an uncertain market world. So it's that constant theme. But the cool thing I like about this is, and I say this all the time, I always question everything, no matter who it's from. Like, I don't care if it's coming from the president. I don't care who you are. Only you know you. You know what I mean? And you got to question it, and you got to get second opinions, and you got to take little bits of pieces from everyone to apply to your unique situation. And I think that's important. Like, and especially in the world, and this is going to lead up here to the asset allocation later in the chapter. How it all depends on your particular life situation, and if your financial advisor isn't concerned about that or getting to know you, then they're not probably picking the best asset allocation for you. Yeah. But before we even get into that, I mean, this just goes into risk, and basically risk is the name of the game here, right? Whenever you're tackling fear, you're taking risk. I mean, that's what risk is, right? Yeah, yep. That's the name of the game. I remember there was a marketing class that here in Austin that someone was trying to get me to sign up for. I went to a meetup, and then it was a few $1,000s, and they wanted me to join on the phone. They were like, we'll give you a few thousand, or we'll give you $1,000 off right now if you take it. And I was like, I don't know if it's going to benefit me or my business. I'm pretty new right now. I got a lot to do. And they're like, well, if you don't act fast, that's something you got to learn how to do. If you ever want to have a successful business, you got to learn how to react right away. And I hear this all the time. Like, you got to be able to make decisions like this on the fly. And I really hate when people say that. And that's this story kind of reminds me of that. Like, I like how Tony he did his own research. You basically come down to a calculated risk, right? You try to reduce that risk. So you want to have some kind of backing to your plan before you do anything or take any risk. So I hate when business people or like top executives say that, you need to be able to make those calls and take those high risk, like on the fly. Like, no one does that. Yeah. No one's smart that I know does that. There are times you have to make a quick decision, like, I got to dodge a car or something, right? Yeah. Or I mean, even think about these like elite soldiers, like these Navy SEALs and people, like they're like nowadays they're trained to think. They gotta look in a hostile situation and know right away if it's a civilian or a hostile that they gotta shoot at. Like, it's more important to be able to do those kind of quick thinking than just shoot, right? Yeah. So I like the theme here, and I think it's gonna apply a lot later as we get further down this book.
I had a statistic in here I highlighted that I thought was kind of scary, and Tony thought it was scary as well. Yeah. That is, a 2015 survey discovered that 60% of millennials distrusted financial markets. Now, you and I are both, sadly, in the camp of millennials. Or I like to call myself old millennial because I am like closer to the beginning of the age limit for millennials. But 60% of folks like us in our generation don't trust financial markets. Yep. And it's not really scary now. I think it'll be scary in 20 years, 30 years. Right. When, I mean, you and I will be retired by then. We'll be sitting on beaches, taking cruises, and doing all this really fun stuff. And our classmates will be holding on. They'll be yearning for the government to come in and bail them out for some little thing. It's going to be interesting, next 30 years, what happens. Yeah. That was really concerning. So definitely. If you're a millennial listening to this and you don't have money in retirement accounts, I don't care if you have general brokerage stock savings accounts or anything like that. Yeah, at least make sure you're putting something away for retirement. Listen to some of our past episodes because it's confusing, but with basics, a little bit of basic information, it's not that hard to get a retirement account started. Just start the account, throw it all in an index fund. Boom. You've probably done 99% more than everyone else out there. Right.
And then we start getting into Peter here. I mean, Tony's intro is pretty short, but and then Peter kind of takes over, like you mentioned. And there's just holy moly, man! And some pretty cool stuff he throws down here. I like the well, like you just said though, like during the crash when everybody ran away, that's when these investors and people like Peter are looking to cash in. I mean, they're getting these stocks at a discount now. And it's funny because I like the quote he has in here, that by Sir John Templeton's famous remarks, is the four most expensive words in investing are "this time it's different."
Yeah.
It's not any different this time around. I mean, we've talked about this a million times, the ups and downs, and I like how he basically tells people that you have two options. Basically, you can try to huddle this crash or get through it with me, and either one of two things is going to happen. What is it? America as we know it
will falter. Yeah.
is over. Yeah. So there will be either the end of America if this crash never recovers, or else there will be a recovery like there is every time, and you'll do all right. So those are basically your two options, right?
And Tony, he kind of says before he gets into Peter's part that you need to look at a low market not as something to fear, but as an opportunity. He says basically the stock market's on sale.
Yep.
Is like, would you buy something when it costs the most, or would you wait until it costs the least, or as close to the bottom? I know when I do price checking on stuff, I'll set up alerts and I'll wait till prices are somewhat low and then I'll buy. I never try to buy at a high end. It's why I don't buy brand new vehicles. It's why I don't buy plane tickets on a whim. I know these markets, they fluctuate, and I want to make sure I buy as low as possible. The stock market's the exact same way. Just wait, be ready for it, basically, so when it's low, you can take advantage of it. And the thing I had concerns about is how do you set yourself up to take advantage of it without already having money in the stock market.
Yep.
And as we move on, Peter actually just talks about that. Like, how do you prioritize your money in a way that if the stock market crashed tomorrow, you and I, anyone else out there, how can we transfer funds to take advantage of this?
Right. And that's what that leads us into diversification in these different asset classes.
Yeah.
He talked about the two people he remembers that were on the sidelines, basically that left his company during the financial crisis. And one of them had a really big real estate nest egg, saw the stock stuff going down after Peter helped him diversify, and bailed out. And then he just couldn't take it. And then he knows that person probably lost his butt because he lost this big opportunity where he sold all his stocks at a huge low, and he'd be in much better financial shape if he would have stuck with that portfolio. And then the other guy he mentioned, where I guess knew someone at Goldman Sachs who said, "It's over. Run away in fear. Invest all your money in gold." And this person drew out everything out of Peter's plan, basically for them, the well-diversified plan, and put everything in gold. And we know that gold has not done well at all. So,
no,
that person unfortunately lost a lot of money in that bet too. But
I've always heard with gold, it's like this is just reiterating what I've heard everywhere else. It's like, why would you put your money in that commodity? So let's imagine again that the stock market crashed like completely, or the apocalypse or whatever happens, rapture. Your gold is worthless because you don't trade gold. You'll trade goods and services and that sort of thing. The absolute worst case scenario, we fall back to a very primitive set of needs. It's like, look at Walking Dead. No one's carrying around gold in The Walking Dead. They're carrying around guns. They're carrying around canned food. They're carrying around bottles of water. They know how to put up fences, and they know how to make spears. Like they don't care about gold. I know that's fiction, but they don't care about gold. You shouldn't care about gold either.
So I guess let's dive into these asset classes here. So for those unfamiliar with diversification, or just it's basically spreading your money, your assets along different classes. So the first one that everybody hears about, you've heard us talk about many times, is stocks, the stock market. And basically, if you buy an Apple stock, you're a part owner in the Apple company. You own a little piece of it, and you hope they do well so that your stock price increases. Yeah, it's the most volatile of the asset classes usually. But over the long run, as Peter says here, historically, it's got an average of 9 to 10% a year over more than a century. So, it's definitely not the highest risk, but best potential reward as well. Stocks, I mean, I lost my spot there. I mean, wait.
Well, putting money in stocks is kind of like putting your eggs in one basket, or putting your eggs in one very big basket. Where, let's say I put my stock in Apple because we mentioned Apple, and then Apple releases, they come out with an iPhone that has no screen, and everyone says that's dumb, and they sell their stock. Well, if other people sell their stock, that lowers the stock price, and because now you have more stock in the market than what was there before. So when the price goes down, your stock becomes worth less, and it almost feels like the only way to be really successful with stocks is insider trading, or insider information, which is completely illegal.
Right.
But it's like if you have a stock tip and I could totally short this stock, and I can make tons of money when people lose money. Like, that sounds awesome, except it's illegal. I mean, you're not allowed to do that.
Right. Exactly.
But other than that, it's like, no, let me just put my money in index funds. That sounds safer.
True. Yeah. Especially if you have a full-time job like us.
Yeah.
And then, so the next asset class is bonds, which is basically a loan. So it's either the government, some entity, basically a government, or a corporation. It could be a city, local, state, or federal government that needs money, and they create bonds, which is basically a way for them to collect money and then pay you back later at a certain interest rate. So it's a loan. They just call it a bond.
When I was a kid, I got a $100 savings bond as a gift from a relative or something, and it took 10 years to mature, but I waited 15, and I took that sucker in. I got like $125 for it. And then I got a tax bill for my $125. I'm like, what? Or the $25 that I made on the bond. It was the biggest ripoff ever. And I had that mentality kind of going into this section because I remember savings bonds were bad value. But he does a really good job of explaining the different types of bonds. Yeah. So, like, if it's to the federal government, it's a treasury. If it's to city, state, or a different country, it's a municipal bond. If you do it to lend money to a company, it's a corporate bond, which I never heard of. Or if you lend it to a less dependable company, it's called high yield or a junk bond. And I'd heard those terms before, but I didn't really know what they meant.
Okay. Yeah.
But I like this idea as it seems like it's slightly better interest or slightly better return on investment than you would get with it's just a savings account.
Oh yeah. Yeah.
And you go into bonds for the long haul. So let's just put these in. Let's let them mature over a couple of years. But after reading this entire chapter, it feels like bonds are kind of that secret weapon of how you take advantage of a bear market. It's like, that tomorrow the market crashes and everything is super cheap. The Dow is way down. It seems like the secret weapon is let's sell these bonds because bonds are liquid. You can basically turn back into cash quickly. And we take the money from the bonds and we buy a buttload of stock. And we throw it in index funds. We throw it into international funds. I don't care what you do with it. But you throw your money where it needs to go. So you're basically pulling money to buy stocks cheaply. And then as the market returns, so he said in a couple cases, like, all right, well, after the 74 crash, it came back within 12 months, like 20%. And then after one of the other crashes, it came back like 30, 40%, which I'm sitting here doing math saying, all right, well, imagine it's $100 and I come in for $100 and I make 20% on my $100. Well, I just made $20. All right, that's pretty good. Let's add some zeros to that. And let me put in $10,000. Well, that's $2,000 I would make. All right, that's a pretty good return on investment. And other than just keeping cash around and throwing it in the stock market, it seems like bonds are that secret weapon. It's like if you have money in bonds, and it's kind of like your emergency fund for your investments or emergency fund for your portfolio. It's not something you just access whenever. It's there for a purpose of when the market finally crashes, and the market will crash again. That's what we're preparing for. But when it crashes, sell the bonds, take the money from the bonds, throw it into the stocks, and use so. That way you don't have to really go out of pocket for anything. I thought it was interesting. Did you kind of get the same gist from reading it, or did I read it differently?
No, definitely, yeah. Because, I mean, basically, yeah, if you just have cash, you're losing money on it. And basically your bonds is going to protect your cash. You're going to generate some income off those bonds to at least kind of keep your money growing. And, like you just said, veer off some of those losses, basically minimize the losses if you were to have all your money in stocks instead, because when the market starts dropping, you'll have some bond money to convert over to buy some of those stocks at a discount. Yeah. So, and that's all about rebalancing, which I'm going to hit on here in a minute, definitely, because that's kind of where that all ties in. And there's some alternative investments as well. Talk about real estate investment trust. And it's funny because this is me big time here. Like he talked, his favorite 3 alternative ones are the first ones here, and then his unfavorable 2 we'll go into as well. But so real estate investment trust, basically, you're investing in real estate, but you're doing it like you would a stock. You're basically trading a fund, and they take care of investing in these, commercial real estate or wherever they're investing or buying real estate and selling it. And getting you a return, and it pays out dividends as income. So that's actually the way I really prefer it. My real estate investment trust funds have done really well for me. I really like them, and I don't want to be a landlord.
Yeah,
that's the big thing. And then private equity funds. So basically, this is where someone like Carl Icahn comes into your failing company and takes it over, and makes it a thriving company, hopefully, and then the investors that helped with that reap the rewards. But it's one of those that requires a lot of money to get into. Usually, what Peter says is a minimum of $10 million investment. Wow, that's pretty crazy. So
I just cash out those bonds I got, and I'm in.
And then the MLPs, the master limited partnerships, I think we touched on this in a previous chapter, like investing in like energy infrastructure, like oil and gas pipelines. So it's just another alternative investment that Peter really likes here. That's something different from the stock market or bonds. And then you have the ones he really doesn't like. We talked about before, gold, stay away, and then hedge funds because of their underperformance and high cost.
And specifically with hedge funds, he says at Creative Planning, his company, we have no place for hedge funds in our portfolios, like at all. He said they're just expensive. They're loaded with fees, and the only person who makes money in a hedge fund is the person who runs it.
Exactly. And I like how he mentions that most of your other alternative investments are going to be illiquid, non-liquid, basically. Yeah. They're going to be hard to sell, like physical real estate, for example, and they're going to be tax inefficient usually. I know real estate can be tax inefficient once that depreciation wears off, and probably has high expenses. So there might be some physical stuff you can do out there, but it's probably it's going to be.
Although he mentioned kind of at the beginning of this section the example of vintage cars in an air-conditioned garage. Yeah. I would totally love that investment. That sounds awesome. Who needs it? I don't need to sell those cars. I need to invest in a bigger garage.
I still have the first 2 original sets of Pokemon cards.
Oh my gosh.
Full sets. So they're sitting away. That's my only collectible investment. So we'll see. Maybe I'll hand those down and they'll be worth, I don't know, a few $100.
I have a box. So if you're watching the live feed, this box right here that I'm pointing to has a bunch of comic books and like old football cards in it that they were given to me. I have absolutely no idea if there's anything of value in there. The problem is I am too lazy to go and research every card and every comic book in this box,
Right.
to figure out if they're worth anything. I probably should do that. Just like an exercise. Take one card a day and go look up the value of it. And it's like, oh, this card's worth $1. Rip it up, throw it away. This card's worth $10 million. Yeah. I'm selling that right now and buying bonds.
That's
a
awesome.
rainy day. There's probably like $500,000 sitting in this box and I don't realize it. I should.
I mean, wow. You might want to put that somewhere before someone comes to your house.
But here's the thing: is I like my risk tolerance. I actually don't. There's probably $500,000 in this box, but there's probably not. It's probably like $10 of. Like I should go to the comic book store and just, what's this worth? All right. What's that worth? All right. What's that worth? Sell.
That's awesome.
All right.
Yeah,
So
there's people here. I'm in Texas now. There's people talk about investing in cattle.
oh my God, really?
There's all kinds of stuff you can invest in, man.
I'll invest in some cattle from my tummy.
Right.
Put it on the Barbie.
You just gotta find that new niche that will get you those crazy returns. But the reason why we're talking about all these asset classes, because now we're gonna get into the fun stuff here, talking about asset allocation.
Yeah.
Because based on all those different classes, we need to figure out what is the right mix of stocks, bonds, real estate, international, U.S. domestic stock, all that. How do you figure out the right mix for you in order to diversify your portfolio to help get through these tough downtimes and to be able to have those bonds that you can sell to get the stocks at a lower, or the opposite, when it goes the other way. So that and I love how the asset allocation part starts here. Especially I love Peter's stance on this, because this is what I love and I live by too, which is the only way you're going to know your asset allocation or what it should be is you have to figure out, okay, what do I need the money I'm saving for? When do I need it? Yeah. Why am I saving? Why am I putting all this money? I know I'm making it grow, but for what? Right? It's funny because a lot of people try to base it on age. Like if you're 55, I think he said you should have 55% of your assets in bonds. Well, just because you're 55 doesn't mean you're retiring in 5 years. You may not be retiring for 15 or 20 years. That matters. Yep. Because then you have maybe a higher risk tolerance. And that's another thing. Some people just try to calculate your risk based on some questions, like what is your risk level? But that's also a poor way. It really just comes down to time horizon. When are you going to need the money? Because how much money you're going to need and when you're going to need it by can determine how risky or how much maybe more stocks you have in your asset allocation versus some of these uncorrelated assets to stocks like bonds and REITs. But it's still good to have some. I think that we get into the rule of 7. Let's not get there yet. But first, I think we should talk about Japan. I didn't know this.
Yeah, I thought about this and I went, we need to talk about this particular section. So go ahead. Explain why Japan is important. So
basically, if you invested in the Japan stock market, it looks like since 1989, it still hasn't recovered to that point. It was at its all-time high in 1989, and it still hasn't recovered past that point. I was shocked because I think about if I have a surplus of money, or let's say I get way past the number I need to retire early, and I start thinking about, hey, I have a lot of extra money, or I really, even though I'm going to go through downtimes, I have more than enough money. Why don't I just put it all in the highest, riskiest U.S. Just put it all in U.S. stock, like 100% equities. Not many bonds or anything, right? Let's just do that. And now that has me kind of frightful because Japan still hasn't come back to where it was, even though we've seen the U.S. one go up and down, up and down. You never know.
That's what threw me off, is that this entire book is built off the fact that if the market crashes, the market recovers and grows past that fact.
Right.
But then they talk about Japan, which does not suffer the same thing. It's like, all right, it peaked, it fell, it has never fully recovered.
Right.
So either, and I wish, 1989, I was 6 years old. So I was like, oh, Mario, Nintendo. That's all I cared about. And all right, so did it artificially peak? Was it there? I just don't know enough about Japanese market in 1989 to know why did it get so high. Were they just doing so well, and all of a sudden something bad happened and it crashed? And
Yeah.
I just don't know. So I would love to know more just about the sentence of
True.
why the Japan market grew so high and crashed and could never recover. Because all of our crap comes from Japan. So why? What's the problem?
That's funny.
And
yeah.
to not think that the U.S. market could not be the same way is kind of interesting. Why are we different?
That's true. Yeah, I think that's almost arrogant, it kind of scares me because I really felt that way, that I could eventually just be 100% U.S. stock at some point when I knew I had more than what I needed to cover my expenses for the rest of my life.
Yeah.
But now I know there's going to be down years, and I really like, on another point, not aside from Japan, I like his rule of 7 here. So basically, in your income producing assets, which would be like your bonds or your REITs or your MLPs, stuff that pays a lot of dividends, basically, and things that don't produce, or basically non-stock. Most of those are going to be income producing, other than cash. You have 7 years worth of income in those out of your portfolio. So whatever your mix is, make sure that if you are, I would say if you're retired, because obviously if you're still working on building to that point. But so at least have 7 years worth, which whatever that percentage might be of your expenses, in those income producing ones. And I think that's so when there is a storm, hopefully you can weather out 3 or 4 years of it, and you'll still have that income coming in from your bonds and REITs to help make you not have to sell your stocks at a low.
I'm looking at our YouTube comments, and we have this glowing review from your wife. She states, "You guys are great." So thank you, Laura. So we really appreciate it.
What a review.
We have a couple of people watching, so this is great. I actually turned the feed off so I didn't have to look at myself talking
funny.
in the past. So awesome. So yeah, let's keep going.
Well, I was actually looking at my asset allocation. So this is the way I do it right now. I have a 4-fund portfolio. And we talked about bonds earlier. We talked about you could buy bonds directly, but I don't do that. I use a bond index fund. Again, I do the total stock market there is a total bond market index fund. I don't do that one. I do the intermediate term bond index fund, which is pretty close to the total one. It's just I don't know. It's not far off. There was a few reasons I picked it, but anyways, so my four assets I choose, though, I'm 40% of my portfolio is in U.S. stocks, 20% of my portfolio is in international stock index fund, and another 20% of my portfolio is in REITs, and then another 20% of my portfolio is in bonds. Gotcha. So I'm basically 60% stock, with 20 of that being international, and then the other 40% is split between REITs and bonds, because they both have low correlation to stocks. So in a bad time, I'll have my REITs and my bonds both generating me income to still help me minimize the downside. And the REITs have actually done really well anyways. I really like the returns on those in the past few years, but I try to stay in that asset allocation, and the rule of 7 I just talked about. So when I get to my retirement figure, when I get to that much money, I'll actually be at 7 years. That percentage, that 40%, will actually be 7 years worth of of my expenses. So I thought that was kind of cool how my asset allocation already kind of matches up with his rule of 7, which makes sense because then I'll have that money I plan on lasting me my lifetime, cover my expenses forever. So it's cool to know that I'm already on track to kind of go along with what he was saying. And I kind of, if you ever heard of Rick Ferry, I kind of my portfolio pretty much matches pretty close to what his is. He chooses the same 4 asset classes, but the percentages are a little different. But that's where I'm at in my asset classes, and I'm pretty happy with it so far. Awesome. I always have bonds, like stocks go up or down. I just kind of every month I'm still investing money. So we talk about rebalancing your portfolio. That basically means whatever percents you chose to choose for your asset classes, you want to make sure you try to stay close to that. And I'm always putting money in every month, so I just kind of pick the ones that are kind of falling off, and I'll buy some more of that because it means they probably reduced or the other ones went up, so I can get the stuff I'm buying more of at a discount. Or if I ever need to, like if let's say stocks really take off and become a big portion of that, then I can sell some of those at a gain and buy some of maybe the bonds or REITs when they've gone down in value. So it's always gonna kind of, if you're always trying to stay within that percentage that you came up with, then you're always kind of buying things at a discount, without really knowing that you're doing it. So it's a good tactic.
Yeah, definitely. And I really got to sit down and do number 6 on this list, which is rebalance. I haven't looked at my allocations in months, and kind of the benefit of us doing this podcast and talking about it and just reading and and learning how some of this stuff works. I need to sit down and I need to reallocate where my stuff is going. And one of the big things, I don't remember where they talked about it in particular, is you really need to be careful about when you sit down to rebalance that you're not moving too much too quickly. So if you might accidentally get hit with capital gains taxes by moving too much money too quickly, just be smart about it. So if rebalancing isn't necessarily selling one thing to buy another, maybe just buy another and to offset your allocation. So don't sell anything.
That's true.
I had a couple of cases where I was going through my IRAs and I was reallocating, and it's like, hey, if you do this, you're moving a lot of money real quickly. We're going to penalize you. We're going to throw some fees at you to do this. I'm like, oh, okay, don't do that. So I will move slightly less money and avoid my fees where possible. I think in that case, I didn't have the money in the fund long enough.
Exactly.
Or I was going to drop. Actually, no, I think I was going to drop it below a minimum. Because I think the particular set of funds had like 10, 15K in it. And I'm like, let me just take 10K out of this and move it into another fund. I wanted to buy Admiral stocks or Admiral funds. And it's like, oh, no, you can't do this. I'm like, oh, crap. Okay, let me do more research into the fees. I think I was dropping below their minimum where they would start charging me fees. But I think if I just moved everything out, which I probably should have done, I wouldn't have the fee, or they would charge me a one-time fee. Just be careful about fees. Like we talked about in the previous chapters, that's how they make their money, is fees and taxes and all that stuff. And it's all in my IRA, so I'm not really getting taxed on it anyway. It's just all getting reallocated. But if it was a brokerage account, I'd get taxed on it. So
definitely know. Yeah, like you said, know what you should be doing in your taxable account versus your tax advantage accounts, because like REITs and bonds should be held in your tax advantage accounts because of all the dividends, and stocks could be held in your taxable accounts. But even then, like if you sell any, you're gonna get, if you got any gains, watch out. Know when to sell. But you said earlier, it's better to buy new, put new money in to do your rebalance always than having to sell something. So try to do that first, or reinvest the dividends. A lot of people reinvest dividends automatically. I turn that off. I want to make sure that I'm choosing where the dividends go, and I'm using that to stay in line with my asset allocation as well. To your point, I think if you move stocks around too often, there's limitations on that. So he mentions to look at it, I think only once a year. I mean, I do my budget every month anyways. I think some people do it once a quarter. I'm putting new money in every month. It's not like I'm getting to the exact percent. I'm not trying to sell and get to the exact percent, but I'm getting close by choosing where to invest my new money.
Yeah.
So that helps me. But again, it's all about it. Your asset allocation again is all about what you plan on doing with the money. I talk about early retirement. I'm planning on building up a portfolio that would pay for my retirement, cover my expenses the rest of my life. You may be saving up money to hand down to your kids,
Yeah.
or to not spend on anything, and people just had a lot of money to stash away, right?
I want that garage full of vintage cars, man. That's my new goal.
And when people are first starting out, you can't get very granular in your asset allocation. Maybe you have your first few $1,000s to invest. You can't split that up between bonds, stocks, real estate, and all that, or else without getting into maybe just ETFs. You really want to maybe get into those Admiral share funds. So you maybe you start off with the more riskier asset classes first, since you're out, got a further time horizon. Maybe you start off with the stocks, and then later on, as you start getting more money in, you can start getting into the bonds, and you can start getting in the REITs, and adjust your new income to match your asset class that you plan to have for when you need that money. So that's kind of how I kind of built up my portfolio too, because you got those. Vanguard has the investor shares, which has like a $3,000 minimum, and then you got the Admiral class shares, which have like $10,000 minimums.
Yeah.
So if you want to get 20%. 20%, 20%, 40%, you can see how that requires a good amount of money to at least get to that point initially.
So, and one of the things I've been looking at this week is where we never established 529s for our kids, so we're looking at establishing 529s. And the two options I really have are Virginia's 529, and then there's like the Vanguard 529. So I sat down, like, what's the big difference between these two 529s? And come to find out, the Virginia 529 invests in Vanguard funds. And it's like, oh, wow. Okay, well, that's kind of cool. And except they put their money in the exact same index funds that Vanguard has. But when Vanguard gives me a 0.16% expense ratio, when I'm in the 529, I get the 1.6 expense ratio plus the Virginia 529 expense ratios and their fees. So my nice little 1.6% expense ratio bumps up to like 0.30 something percent. It almost doubles because of the Virginia 529 fees for managing the money. It's like, well, that's insane. Why don't I just go to Vanguard and pay a lower expense ratio, and I get the same Vanguard funds I would want anyway?
Yep.
Because Vanguard, to start a 529, has a minimum of $3,000 that you have to put in. The Virginia 529 has no minimum. You just start it. It's like, well, that makes sense. But I have $3,000. I'm just might as well kickstart the 529.
True.
And I'll save. I can make all that money back that I would have spent, or that I would have saved.
Right. And from the expenses,
yeah, just throw in a couple index funds and go, and let it ride.
That's right.
So it's interesting. It's like you really have to be careful about what you're doing and watch everything.
Yeah, you do. It's crazy. And I remember another mistake people make. I remember when I was very new to this, when I first heard of asset allocation, I did an asset allocation for every one of my accounts. So like my 401k, I gave its own asset allocation. My IRA is its own. My brokerage account had its own. And that was wrong. You should really look at your asset allocation as a whole picture.
Okay.
So your portfolio as a whole, you need to know all the money you have combined of all your assets, what's the total value, and then you decide, you split up the money, and you, based on where that asset would be more tax efficient, maybe you use your 401k for your bonds mostly, or your REITs, and you're taxable for all your stocks. But you really divvy up that percentage across your whole portfolio, not individual portfolios having their own asset allocation. And a lot of people don't include their house as well. Like if you have equity in a house, like that's
Hey, our property values just went up this year.
Oh wow.
The
Tax
8
value.
years 8 years I've lived in this house. We bought our house. The value dropped, not significantly, just like 10 grand. But this is first year where it's up above where we bought, and
Nice.
so I'm like, I have equity. I don't know what this feels like. It's like my house is worth something now. So yeah, I never think about that.
Right. Well, cool. I think we about smashed that one.
It was a good chapter. It was a long chapter, but all like really good actionable advice in there. And
Yeah.
we start a new section the next week, or actually not next week, but our next meeting. What's the name of the new section? I totally closed the book without.
It's the psychology of wealth.
Yeah,
Si-
so
Silencing the enemy within.
6 money mistakes investors make and how you can avoid them. All right, that's cool. So, yeah, it won't be for next week, but it'll be for the week after. We have a special guest next week.
That's right.
All right. So
Alrighty.
whose
You up?
whose turn? Is it my turn? All right.
Go for it.
That's all for this episode. Thanks so much for tuning in. Don't forget to follow us on Twitter at Two Frugal Dudes, as well as Sean at Sean Marin and Kevin at One Kev Griff. View show notes, check out previous episodes, and never miss an episode by subscribing to our mailing list at twofrugaldudes.com. If you like this podcast and want to keep it going, please rate us on iTunes. And don't forget to ask us a question, and we'll enter you in for our drawing for a copy of Unshakable by Tony Robbins. Cha-ching. And I realized on our live feed, I put your Twitter, and I used your email alias and not your Twitter alias. So the live feed's been completely wrong this entire time. And
Nice.
I didn't realize that until I was reading the outro. I'm like, oh, crap. All right. Oh, well. So whoever is Marin Sean on Twitter is going to get some followers, maybe. So during this whole thing, the stupid batteries in my mouse went out.
Oh, no way.
I'm sitting there trying to move my mouse. I'm like, oh crap. So I end up like having to go over to my trackpad on my laptop. And I have 3 monitors, and trying to move the mouse across 3 monitors on a trackpad is really cumbersome.
Yeah, that sounds horrible.
So awesome, man. All right. Oh, let me stop recording. So stop recording. So thank you to all 3 people who are watching us live.
Yeah.
So
Thanks for joining.
Thank you, Laura. I'm not sure who the other 2 people are, but
Good to have them.
alrighty. So I will go ahead and stop OBS. So bye, interweb net web thing.
Interweb.
Interweb.